Hello all, welcome to ETF Edge, your go-to place for everything ETFs. I'm your host, Bob Pisani. International investing is hot right now. For the first time in a long time, emerging markets in Europe have outperformed the United States. How long is that going to last? We're going to talk about that, as well as dividend investing in the U.S. and ETFs this year. Panel of experts, three of the best in the business with us right now. Jeremy Schwartz is Global Head of Research over at Wisdom Tree. Brian Lake is the head of America's ETFs at JP Morgan. Tom Light, my old friend, CEO over at ETF Trends. Tom, let me start with you. Generally, we've got this is a broad question, but we've got a new administration in Washington. I'm wondering what your thoughts about what, if any, effect the Biden administration might have on the ETF business. Anything that's on their plate that's going to affect this business.
Yeah, initial indication, Bob, is the new administration, the SEC, will continue to support ETF issuers after a record year of flows last year. You know, all the right things: transparency, diversification, low cost, tax efficiency, and this big wave we're seeing of transitioning mutual funds into ETF wrappers. I think some of the key things will be, most recently, there's been an interest in the standardization in ESG research, as most issuers and index providers that they partner with have their own proprietary definition and offering of ESG. I think it will be one of the mandates for the SEC to standardize that a bit. And even though Janet Yellen is somewhat concerned about crypto, it's really not her job. Biden's nominating Gary Gensler, former head of the CFTC. So that actually may help for the mandate to get cryptocurrencies in ETF form. And then finally, we saw a huge interest in IPOs last year. As you know, the IPO Renaissance ETF was up over 100%. So there's a big hunger among ETF investors for IPOs and pre-IPOs in the form of SPACs. Today, as you probably saw, there was the third SPAC ETF that was launched by Morgan Creek Capital and Mark Yusko. So I think that's an area that Gensler's going to look at. He's expressed some concern over transparency and the internal interest of those behind the SPACs as far as ownership and incentives.
Yeah, that's by the way, we're going to have Mark Yusko on Monday on ETF Edge. Those of you who want to know more about that SPAC ETF that Tom's referencing. Brian and Jeremy, if you want to weigh in on the Biden administration and thoughts, feel free. But other than that, Brian, I just want to move on to the international markets because that's our main topic today. We've seen these Asian markets outperforming in the U.S. China is up 10% this year. It's the hottest market in the world right now. What do you believe, or why? I know you said you do. Why do you believe international stocks might have a shot at outperforming the U.S. this year, and any specific areas that you think might outperform?
Yeah, that's right, Bob. And kind of picking up where you started, one of the major reasons we think is because with the new Biden administration, there should be less trade uncertainty. And so I do think that will have a stabilizing effect. In addition to that, you know, the valuations are extremely attractive. On the international side, we saw some of the biggest drawdowns last year. And so we are expecting that snapback. And then, yes, to your point, China is contributing heavily. They've obviously been one of the first to hit that reopen trade, which is driving it. From our perspective, we do like active. One of our concerns is that the major benchmarks on the international side are heavy banks and heavy energy, whereas we're more positive on areas like clean energy, semiconductors, and luxury goods. So we do think there will be some differentiation with that. One of the best ways we think you can play that is with our international growth ETF, ticker JIG. This has 50 to 70 names. It's an actively managed portfolio. Portfolio manager's been in the industry for decades. Does have 14% weight to China, and so we think that's a great way to participate in what we think could be leadership on the international side.
Yeah, and that JIG, there it is, has been straight up for about a year. I wonder if we could put up some of the main components in that. And I see it's Taiwan Semiconductor, Tencent, Alibaba, all names we know. Nestle is one of the few European stocks that are in there. ASML also in that as well. How do you weight this particular international growth ETF? Is it just what goes? How do you decide what the weightings are?
Well, it's an actively managed portfolio, and so we're going to take the names where we have the conviction that we think can participate. in the particular sectors that we think are positioned to benefit from potentially this reopened trade, which is why we like that. So, this is a bottoms-up, fundamentally selected portfolio of names where we're doing the research, leveraging our global footprint of analysts, and identifying the names that we think need that weighting, and then we have conviction. Like I said, it's going to be a relatively concentrated portfolio with 50 to 70 names.
Yeah. Jeremy, same question for you. I put up a few moments ago, we put up some of the global markets, and the U.S., as well as it's been doing, is the laggard so far this year. China, South Korea, Japan, even Europe are outperforming the S&P right now. I know you're fairly bullish on international. You've got a suite of international ETFs as well. Why do you think this is a year for international? It's got to be more than just a weak dollar, obviously. What's behind the good feelings on international this year?
Yeah, I think some of the case for international is you have this reversion and trade rotation where you had large cap growth, U.S. tech dominating. You're starting to see that leadership change, and so you're seeing a little bit more cyclicals. Growth globally increasing is good for international. And when you think about the U.S., it's really tech dominated, and it's sort of that shutdown economy doing well for U.S. tech. And as you reopen, the international cyclicals, I think, can do well. Emerging markets on that better trade tension is a long-term view. We think that's some of the growth dynamics, echoing what Brian just talked about. We think those EM tech giants can be, the rivals to U.S. tech giants over the long run. So that's sort of a more of a strategic long run type allocation. Whereas when you think about Europe, you think about Japan, they can be more the global growth reacceleration. And I think that's where you might see some interest there.
Yeah, you have one of the interesting things about Wisdom Tree is you very much emphasize the importance of removing currency as an effect on it to get to a sort of pure play on the stock prices. You have several hedged ETFs that have done very well. Your Europe hedged ETF, and I wonder if you can explain how this works, how you hedge out the currency, but Unilever, Lind, which is a material stock, ASML, BASF, famous company, of course, another material company, L'Oreal, all major components in that. How do you pull out the currency here? Explain how you're doing that, the currency hedge part of this.
Sure. No, I think that's one of the key questions. When you go overseas, you have to sell your dollars to buy, euros to then go buy the underlying stocks. And the question is, are you bullish the euro or not? For emerging markets, there could be a high cost to hedge. In the developed world, because of the negative interest rates at the ECB, the negative interest rates at Swiss, negative interest rates in Japan, you're actually paid to hedge. It's not just like a short-term phenomenon. You've actually been paid to hedge on average last 3 decades. And so we kind of say, there's no expected return from currency. It's sort of expected risk. Now, if you think there's a big weak dollar move, that's a reason not to have it, and that's sort of an active decision. But if you don't really know and you're sort of more neutral, hedging lets you get to a baseline of neutral. I think, for EM, again, cost is higher, but for the developed world, Europe and Japan, it's sort of a better than free option that you're sort of paid the interest rate carry to not have to take it. And so I think for Europe and Japan in particular, it's markets we'd say people should be more hedged than they often are.
Yeah, I think that's a really good point. Let me, Tom, why don't you weigh in here on your thoughts on the international market? What's striking to me is this is the first time we've actually had this conversation in years. The United States has outperformed emerging markets for I don't know how long, 10 years. It's outperformed China, it outperformed Europe for 10 years. I know the era of emerging markets, it seems to me, was the 2000s. That did really well up until the great financial crisis. And then it fell apart. It never really recovered. And only now we're talking about it. Or am I exaggerating a little bit? And tell me if I am. But why is everybody so bullish?
Well, we survey thousands of advisors every week, and they are very bullish on international markets, very bullish on emerging markets. And as these guys said, just to put in perspective, S&P is trading at a forward PE of 25. The MSCI ACWI is at 20, and emerging markets is at 15. So you can actually buy emerging market stocks for a 40% discount. And on top of that, as Jeremy was touching on, there's a strong case for the U.S. dollar continuing to slide, and that can actually work in your favor as well. So there's a lot of reasons to consider that right now. These folks do a great job in global investing. And then one thing to put on top of that, we don't spend a lot of time talking about dividend opportunities overseas too. And both J.P. Morgan and WisdomTree, number one, have expressed concerns about fixed income investing in the U.S. and also have talked about the opportunities for dividend or getting that income in the form of dividends by buying international markets, which are very, very attractive today. So for all the right reasons, it really makes a lot of sense.
Yeah, Brian, last word on the international part of this thing. Tell me, do you think a lot of this really boils down to about overseas is the dominance of U.S. technology stocks in the 2010s? When I look around the world, what is challenging them? I don't see much. I only see some China tech stocks. I see Alibaba, I see JD.com, I see Tencent. Is there any argument that could be made that China tech giants could challenge U.S. tech giants and be a major force in the 2020s, or is the politics of it get too involved? Weigh in on that.
Yeah, so you raise a good point, right? And I think what we're going to continue to see is a difficulty for U.S. tech giants to penetrate China in a meaningful way. Challenges from just a governmental standpoint, languages, how things transfer over. We know that that's been a story for a long time. But we also know that the mainland China marketplace is enormous. The demographics are huge. There was $1.7 trillion in e-commerce sales last year alone. 60% of that is happening on a mobile device. That makes up 29% of their retail sector. So some of these China names have an amazing growth story within mainland China itself. And if those names can just own their own home market, I think you're going to see a huge appreciation from them. There's still a lot of untapped potential in China alone. And then I think we will see them start to come to other markets. But I think they're going to keep themselves really busy in mainland China. To your point, your U.S. tech companies have done a great job really in every other market except for China, where you're starting to see some leadership there. So I think this is going to be a story where you see both Chinese tech and U.S. tech powering forward in their own specific lanes, if you will.
But Tom, where does the politics come in here? Where does the political difficulties China has relating to the rest of the world come in here? I'm wondering if that could prove some kind of break on, all of a sudden, Alibaba is as important as Apple and Microsoft story, the penetration story in other countries. Or am I trying to make too much out of the whole political situation?
No, it's going to be in the spotlight, Bob. And, it seemed that the Trump administration was pretty tough on China, and that the Biden administration probably is not going to be as tough. So that will, in fact, bode well for China. However, state-owned companies, the influence on companies like we've seen with Jack Ma somewhat being silenced recently is a concern, and I think a lot of people will be paying attention to that. However, we're still in the early stages of China A shares especially, and there's some great opportunities there as well. So it's an area to really pay attention to. There's some great upside opportunity.
Yeah, I want to move on and talk about something I'm very interested in, and that is dividend products. We get a lot of interest in this from investors. And Jeremy, I know WisdomTree has got a very interesting suite of dividend products, including a dividend growth ETF. You've got a mid-cap dividend ETF, a large-cap dividend, a small-cap dividend. You kind of cover the universe there. Tell us a little bit about how you weight these products and what future does dividend producers have in 2021. We're putting up here some of the specific names of WisdomTree products here in the dividend space. But tell us how you weight these products.
The key, on just the case, Tom brought it up earlier on, just the historically low yielding environment, rates at zero, short-term rates at zero, the TIPS yields, the inflation adjusted yields at negative rates, negative 1% plus. The Fed wants to target more than 2% inflation, and you're just getting a little bit over 1% on your 10-year. I mean, it's a tough spot for investors who need income. And so, we kind of think of dividends as things that can protect from inflation over time. They rise. If you go in the 70s and 80s, dividends grew 6%. Dividend growth was more than inflation during the high inflation decades. And we expect a return to inflation. So that's a sort of macro case. In terms of how we weight these portfolios, unlike the market cap weighted indexes, these rebalance back to dividend streams. So Apple pay 10 billion plus in dividends. You take all the total dividends in the U.S. and divide it by that total dividend stream. Last year was a tough year for, let's say you showed some of the mid and small cap dividends. Large cap dividends were only down 2-3% in aggregate. They weren't down by a lot. But when you go to that mid and small cap, they're down 20 to 25%, at the bottoms they're down even more. And so that was really the shutdown economy. The sort of mid and small caps more sensitive to the US, to the shutdown, large caps, quality, more tech, more healthcare, not as impacted with the virus. But as you get to a reopening, I mean, we're starting to see like emerging markets leading this year. You're seeing small caps leading, sort of the reopening benefiting. It started with the election, then the vaccine. It's been doing well.
But Jeremy, I wonder if we could put up what's in the U.S. dividend growth, the largest holdings here. So I see Apple, I see Microsoft, Johnson & Johnson, Verizon, and Procter & Gamble. This is like, mega cap land here. Is Apple in there because why? It's growing its dividend? I mean, Apple does not strike me as a big dividend provider or even growing it. But what's the criteria here for including companies?
It is the biggest.
Like
it's basically one of the biggest dividend payers in the world. So when you take the total dividend stream it's paying, essentially the dividends per share times shares outstanding, which is sort of a modified market cap, giving more weight to the more dividends they pay. It screens for quality. The specific screens are growth and quality. I call the quality screen your Warren Buffett factor. He always says I buy like high return equity and no debt when he says like what types of companies buy. That's half of the screen is those quality factors. The other half is earnings growth, traditional Russell growth type screens. You package that together and then you weight back to the dividend stream once a year. It just did that in December. And so that higher quality nature, we think, leads to companies that can sustainably grow their earnings and dividends over time.
Tom, can I be a curmudgeon on dividends? Here's a problem I've had for years. The viewers get me a curmudgeon? No. You know me, Tom.
No.
The viewers think dividends are free. That's the problem I've got with this whole thing. They think that, if a stock is $100 and it pays out a $2 dividend, that's like $2 that's free. But it's not free. You and I know that if it pays $100 and it pays out a $2 dividend, the stock is down $98. That there is no free lunch out there. And every year we just get so many emails. How do I get more, dividends out of the thing? As if the dividend that you're going to get is suddenly going to cause your total amount of money that you're going to have to outperform everything else. And I don't know if that's the case or not. Or am I just being a curmudgeon on this?
You're not, Bob. I mean, everybody has to rethink income today. You think about a classic 60-40 portfolio. People are living longer. That 40% allocation, many advisors are thinking in the next 5 years might be dead money. Might be not only that you're not going to make much, but you might lose money if we start to see a little bit of a creep up in rates. As you're looking at this ETF, DGRW, and you look at the holdings, these are some of the best performers in the S&P 500 in the last 10 years, but they're fairly priced and they're kicking off decent dividends. If you're retiring at 65 today, would you rather have these types of companies in your portfolio in the next 25 years or be exposed to the bond market where you're not making much of a yield? And in fact, that money is at risk if we do see higher rates. So we're seeing more and more of a shift to more of an allocation towards dividends.
Yeah, but that's an argument for the predominance of the quality screen, I think, rather than on the dividends. Brian, I've sort of left you out of this. I don't know if you have any thoughts on the whole dividend question, but it's a big issue. My point is that dividends are not free, and investors somehow think that I don't know why, they think that they are, but they're not. So the question is, how do you pull out money in a situation people who want to pull out money in a situation where there's not a lot of money to pull out. It makes some sense to go into high dividend payers, but there are risks with doing that. Look at ExxonMobil. We don't know if ExxonMobil's dividend is safe at all, for example.
Yeah, Bob, you're right. And I agree with what Tom was saying. What I think we're really hearing from investors is less specific on dividend and more specific around I need income. And I do think that investors are continuing to look for income in the markets, particularly because they're not so sure that the bond markets are going to be able to provide that for them. One way, obviously, you can do that is by getting option premiums, right? And so we've actually launched an actively managed ETF, JEPI, JEPI, which is essentially a covered call overlay strategy. It's got active equity underlying, but then using the option markets, we can overlay on that. And the way we think about that one is, it protects to the downside, so you're only going to get 60 to 80% of the downside. But on the upside, you can get a 6 to 8% yield off of this. And so that can really start to drive a nice income story for you. It's not a dividend per se, but that is that income that we think investors are looking for. On the other side of the table, and tying it back to the Biden administration, investors are also starting to think about, are my taxes going to creep up? And they're also seeing that there's going to be an aggressive infrastructure program. And so could municipalities benefit from this? Munis. We've got an ultra-short muni ETF, which can get you 85% of the yield, the tax equivalent yield of a 10-year treasury with only 8.5% of the duration. So I do think investors are continuing to look for income. They might not be looking in the traditional dividend bucket. They might need to look in some other areas for their portfolio.
And the symbol for that is JMST, am I right? I'm just looking off camera here. Is that right?
You're exactly right, Bob. JMST.
Okay, so investors, you might want to take a look at that. That's a very good point. I'm going to have to leave it there, guys. This is a fascinating discussion. As you can see, best in the business, international, dividends, doesn't matter. Biden administration, we could talk about anything here at ETF Edge. I want to thank Brian, of course, and Tom, and Jeremy as well. You can see all of our videos, of course, etfedge.cnbc.com. And by the way, Monday, 1 p.m. Eastern Time, Tom mentioned that new SPAC ETF. We're going to have the people on who put that out, and it's going to be out next week. A lot of talk about the SPAC business right now. We'll get down to that and how it relates to the ETF business. I'm Bob Pisani. Everybody have a healthy, happy, and safe trading week.
Get the ABCs of ETFs with the ETF Edge newsletter, your weekly update on the hottest trends in the nearly $4 trillion market of exchange-traded funds, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.